Hello again, Mark Garcia, CrushingTheCreditBureaus.com and ImproveMyCreditScoresWorkshop.com. In this next segment, I want to talk a little bit about the difference. Now, this is not only for my real estate investors, but also for any of you personally who may have a home equity line of credit. We're going to talk about the differences between a home equity line of credit, or HELOC as they're more commonly referred to, and a home equity loan. At the time of this taping, it's mid-2008, and the mortgage industry is in a tailspin, is putting it mildly. You're seeing several of the large subprime mortgage lenders are going out of business, or they're seeking the protection of larger industries, larger banks. We've recently had a very large Wall Street firm basically go belly up that had a lot of exposure to the subprime mortgage market. So traditionally, what had been the largest access of cash for individuals, their home, is in a little bit of a tailspin right now. You're seeing in some parts of the country where home prices are actually lowering. So that quick access, or the ability to tap into the home equity that a person may have, has been somewhat diminished. I'm not saying it's not out there, it's just a little bit harder now to access that. In this segment, what I want to cover is the big difference between the way a home equity line of credit, or HELOC, and a home equity loan, the way those report on your credit score, your credit bureau report, but more importantly, how they impact your credit score. I know a lot of folks, especially a lot of my real estate investor clients and students, have HELOCs that they've tapped into either for their real estate property or just they've had their own home appreciate so much and they want to tap into some of that equity. Now the problem with that, as you've seen in some of the areas of the country, the home values have dropped. So people now actually owe more on their homes than they're worth. We're not even going to discuss whose fault this is or what brought us here. I mean, I have my own thoughts on the whole subprime and the adjustable rate mortgages that took place, but specifically I want to talk about HELOCs and home equity lines of credit. And again, as you know, I tell you straight how it works within the FICO scoring algorithm. We're not going to talk about the way that things should be. We're going to talk about the way they are. Now, specifically to the FICO scoring algorithm, a home equity line of credit, or HELOC, reports differently than a home equity loan. Now, let me say that again. For purposes of credit reporting and credit scoring only, a HELOC, home equity line of credit, in my view, is bad to have on your credit report, and I'll tell you why. Because it reports differently to the credit scoring algorithm, meaning that a HELOC almost shows up like a credit card. Okay, even though I know it's not a credit card, when we do workshops and preview seminars around the country, this question always comes up and I have to spend a lot of time discussing it with the students, so I want to make sure I go through this very detailed and meticulously. A HELOC, home equity line of credit, and again, through no fault of your own or through the credit bureaus, it's just the way typically the company that you have that loan through is reporting the loan. It shows up as a credit card. So let's say that you get a $40,000 HELOC from one of the different vendors that's out there in the marketplace. What they show is that you have a $40,000 credit card that you're using at full max if you've tapped into all of your HELOC. And let's face it, most real estate investors or most individuals, if they have a HELOC, they're going to use it either for remodeling or home improvements or for other investment projects. So the way that that's showing on your credit score with the different bureaus, it's showing you that you have an installment account that has a limit of whatever it is, $30,000, $40,000, and that you're using all of that limit. That's a negative. We've talked about this in other segments and in my book, even in Crushing the Credit Bureaus, about having too high of a utilization ratio on your credit accounts causes your FICO scores to be low. Okay, makes sense, right? According to the algorithm, if you're using all of your available debt, that's not a good sign. So I don't like HELOCs for that reason. A much better way to tap into the equity of your home property is to use a home equity loan. Again, HELOC, home equity loan, they sound very similar, but they report differently on your credit report. Okay, a home equity loan shows up just like a mortgage or just like a car loan. It shows up as an installment loan. There's a certain amount of principal, there's a certain monthly payment that's made every single month, and obviously if you're paying that principal amount and some of the interest every single month, it's going down. But the biggest part is it doesn't show up as an installment loan or as a credit card type of account on your credit score. So it's not going to affect your scores as much. Again, everybody gets confused when I present this a little bit because I know it does sound a little strange. It's like, wait a minute, it's not a credit card, it's a HELOC. Yes, but just understand me that the way it's showing in the FICO scoring algorithm, it shows up as a negative. Now, there's a couple ways you can fix it. I have folks say, great, Mark, I already have a HELOC. What the heck am I supposed to do? If you can, try and transfer that, try and either through another bank or through your current lender to try and get that as a home equity loan. You want it reporting differently. Now there's a couple instances where a HELOC won't report in the fashion that I'm describing with the installment loan. Most times, not all, but most times, if it's over $50,000, it won't report in a similar fashion like an installment loan. But you still got to check. That's why you're going to go to myfico.com/12 and pull your credit reports. You're also going to ask for for hard-written copies of your credit report, because you're going to get more information of how those things are reporting. But what you're going to want to make sure, if you have a HELOC, or whether it's over $50,000 or not, you want to make sure it's reporting to the bureaus correctly if you can't change it to a home equity loan. The other way that a HELOC would not show up in your credit report as an installment loan is if there's a comment. But the only way a comment would be listed on that account would be, once again, if it's up to the issuing bank that you have your HELOC through. So for my real estate investors and for my personal students or even prospective students, be very cautious of HELOCs and home equity lines of credit. If you have to use them, which let's face it, a lot of us have or choose to, always make sure that you do a home equity loan, because it shows up truly as a loan in the scoring algorithm and it won't penalize you. If you have a HELOC already, there's two things you can do. One, try and factor out of it and try and get a home equity loan if you can. Or two, when you pull your credit reports, you want to make sure that it's showing, and I've got some information on you so you can show how to verify that it's showing as a HELOC, not as an installment loan, or by simply reaching out to the company that you're doing business with and say, hey, listen, I just pulled my credit reports. I want to make sure that this thing isn't counting against me. You know, can we put a comment in the field into the status? So it's a little bit tricky, and this is kind of one of those hidden things out there that not a lot of folks are aware of. Having a home equity loan is okay, but you just got to make sure that it's reporting the right way. Now, if you want to find out more information about HELOCs or other ways to improve your credit scores, whether you're a real estate investor or just someone who's trying to improve their lifestyle, you can go to crushingthecreditbureaus.com. We have a 150-page book that explains everything on how to clean up negative information in your credit reports, but more importantly, how to condition your credit scores so you get the higher FICO scores to be able to get the access to the higher lines of credit or to the higher limit credit card accounts, or to qualify, much like a lot of folks are trying to do right now, to qualify and get a lower interest rate out of their main mortgage or out of the mortgage of their investment properties. Again, this is Mark Garcia, crushingthecreditbureaus.com and improvemycreditscoresworkshop.com. We'll see you on the next one.